In a development that has significant implications for global banking and the precious metals market, the Bank for International Settlements, known as the BIS, has formally implemented the final phase of Basel III regulations. The changes, which were quietly approved in Basel, Switzerland, mark a major shift in how banks must handle gold and silver on their balance sheets. While retail investors have largely focused on market price movements, the fundamental decisions that will shape the metals market in the coming months have been made behind closed doors. These rules are now official and are set to take effect as financial markets open on Monday. Basel III, often described as the central banking regulation of central banks, has long been evolving. The latest amendments, commonly referred to as the Basel III Endgame, address bank capital requirements and how banks account for high-quality liquid assets. For decades, banks have been able to hold unallocated or paper gold and silver, treating it as equivalent to physical metal. Starting Monday, that practice is no longer acceptable under the new Net Stable Funding Ratio, or NSFR, rules. Unallocated metal will be treated as a riskier asset, and banks will face higher costs and regulatory penalties if they continue to hold these paper contracts without physical backing. The practical impact of this change is considerable. Banks that previously engaged in large-scale short positions in gold and silver now face new incentives to either acquire physical metal or reduce their exposure entirely. Holding shorts without physical coverage will carry a substantial capital cost. This regulatory adjustment is intended, in part, to prevent another financial crisis similar to that of 2008, but it also has the effect of increasing demand for physical metals. Market participants have already observed early signs of banks adjusting their positions, and this shift in behavior is expected to influence both gold and silver prices in the coming weeks. A particularly important aspect of the Basel III adjustments is the reclassification of gold, and by extension silver, as a Tier 1 asset. Previously, gold was treated as a non-cash, moderately risky asset, similar to equities. Under the new rules, gold is now considered risk-free capital, equivalent to cash or government securities. This encourages banks to hold physical metal to strengthen their balance sheets rather than relying on paper contracts. By doing so, the regulations effectively change the dynamics of the market. Banks move from being sellers of paper metal to buyers of physical assets, creating a permanent support for prices. This reclassification is also a reflection of international trends, as markets such as the Shanghai Gold Exchange have long operated on a fully allocated, physical basis. Western regulators are now aligning with this approach. The implications extend beyond the banking sector. Industrial users of silver, including major technology and manufacturing companies, are adjusting their strategies to secure supply before the banking sector absorbs available inventories. This is creating a competitive environment in which physical demand may exceed the current retail and industrial supply. Analysts suggest that this tension between physical availability and regulatory compliance could lead to a period of increased market volatility. However, unlike speculative volatility, this activity is rooted in regulatory compliance and the mechanics of balance sheet management. Another important consequence is the potential impact on currency and credit markets. As banks acquire more physical metal to meet the new NSFR requirements, they may need to reduce holdings of cash or government securities. This could place downward pressure on the U.S. dollar and influence broader financial conditions. At the same time, the increased capital requirements for banks could lead to a tightening of credit. Borrowers may find it more difficult to access loans or mortgages, and commercial lending may slow, contributing to a complex economic environment that balances regulatory stability with potential short-term financial constraints. As the market prepares for the full implementation of these Basel III rules, the key takeaway for investors is that the regulatory landscape has fundamentally shifted. The days when unallocated or paper gold and silver could be treated as equivalent to physical assets are ending. Banks and financial institutions are adjusting their positions in anticipation, and industrial users are responding to the expected supply-demand imbalance. These changes are already influencing market behavior and will likely have ongoing effects throughout 2026. As these developments continue to unfold, it is clear that the era of relying solely on paper contracts in precious metals markets is coming to a close. The regulatory reset initiated in Basel signals a move toward transparency and risk-based capital management, with physical metal at the center of the financial system. While the full effects will take time to materialize, the groundwork has been set for a significant transformation in how gold and silver are held, traded, and valued. In the next segment, we will examine how these changes are expected to ripple through the broader financial system, including derivatives markets, industrial demand, and potential implications for retail investors and global economic stability. The impact of Basel III's final implementation may be far-reaching, affecting not just precious metals, but credit, currency values, and investment strategy around the world. Continuing from our earlier report, the implementation of the Basel III Endgame rules is expected to have a cascading effect across multiple layers of the financial system. One of the most immediate consequences will be in the derivatives market. For decades, banks have been able to leverage paper contracts and unallocated metals to facilitate trading on a massive scale. With the new NSFR requirements, the cost of holding these positions rises substantially. Banks will no longer be able to support large-scale short positions without allocating capital for physical coverage. This shift is already prompting adjustments in overnight markets, as financial institutions recalibrate their exposure to comply with the regulations before Monday's effective date. Hedge funds and other market participants who rely on cheap leverage for speculative positions are likely to encounter a more constrained environment. The combination of higher capital requirements and a reduction in available paper contracts is expected to trigger a process of short covering, where traders buy back positions to reduce risk. Unlike typical market rallies driven by speculation, this buying activity is regulatory in nature. The mechanics of compliance are effectively creating a structural demand for physical metal, which has the potential to support higher prices over time. Another significant impact relates to the allocation of gold and silver between banks and industrial users. With banks now incentivized to hold physical metal as part of their Tier 1 capital, a larger portion of available inventory may be absorbed directly by financial institutions. Industrial consumers, including manufacturers of electronics and green technologies, may face increased competition for supply. Analysts note that this dynamic could lead to tighter markets, as factories and technology companies seek to secure metal for production before it is acquired for regulatory compliance. This interplay between financial and industrial demand is a new factor influencing pricing dynamics. Internationally, the Basel III changes align Western practices more closely with those already in place in parts of Asia, particularly China. The Shanghai Gold Exchange operates on a fully allocated physical basis, meaning that all gold traded on the exchange is backed by actual metal. By enforcing similar standards, Western regulators are implicitly recognizing the stability offered by physical-backed holdings compared to paper contracts. This convergence may also influence global capital flows, as countries and sovereign wealth funds adjust their positions to reflect the new classification of gold and silver as risk-free assets. From a macroeconomic perspective, the requirement for banks to hold more physical metal may influence broader financial conditions. The acquisition of metals could necessitate selling other assets, such as cash or government securities, potentially exerting downward pressure on the U.S. dollar. At the same time, banks may become more cautious in lending to meet their higher capital requirements, creating tighter credit conditions for borrowers. These combined effects could contribute to a period of slow economic growth, even as inflationary pressures persist, producing conditions some analysts describe as stagflation. In such an environment, historically, precious metals have served as a hedge against both inflation and currency depreciation. Regulatory oversight will also increase under Basel III. Banks will be subject to audits to verify the physical presence of metals on their balance sheets. This requirement reduces the ability of institutions to rely on leased or rehypothecated metal, a practice that has previously allowed multiple claims on the same physical bar. For investors, this focus on audit-proof metal is an important signal. Physical possession and verifiable allocation are becoming central to the definition of a safe, Tier 1 asset. Miners and producers of precious metals are positioned to play a critical role in this transition. As banks and institutional investors seek to satisfy the new requirements, direct purchases from mining operations are likely to increase. This could bypass traditional retail markets and intensify competition for available supply. Consequently, individuals and smaller investors may face higher acquisition costs if they seek to purchase physical metal in the near term. Looking ahead, Basel III's implementation represents a structural shift in the financial landscape. The reliance on paper contracts and fractional reserve practices is diminishing, and the emphasis on physical collateral is reshaping market behavior. Banks, industrial users, and sovereign wealth funds are already positioning themselves to align with the new rules, anticipating the broader effects on both pricing and liquidity. For the public and retail investors, understanding these developments is essential. The environment is moving toward physical asset backing, and the incentives for holding unallocated or paper positions are changing fundamentally. In summary, the final phase of Basel III is more than a technical regulatory update. It represents a systemic realignment that affects gold, silver, banking operations, industrial supply chains, and global currency markets. The shift toward physical, backed Tier 1 assets has the potential to influence price levels, tighten supply, and change the behavior of both institutional and retail participants. As these rules take effect, the implications for credit conditions, monetary policy, and market liquidity will unfold in the coming months. Observers and investors alike should monitor these changes closely, as they mark a decisive moment in the evolution of global financial markets. This concludes our coverage of the Basel III implementation and its anticipated impact on precious metals and the banking system. The regulatory changes are now active, and their influence is expected to be both immediate and enduring, shaping market dynamics well into the year ahead.